So, last time we talked about long-term asset and liability management. So I realized that my not so great setup to survive, it requires at least 800 million euros to survive the first 2 years, or to cover the first 2 years expenditures, because this is necessary for cost of sold goods and wages at least. And then we had 3 options. One, private equity by issuing new shares. That was the cheapest solution. Then there was bond issuance with 5-year maturity. And then there is financial lease, so we have to sell some of our assets and then we have to lease them back. But since the money requirement was so high, then still I have to take up loans, just now to combine lease with loans. And after that, I had to determine that to collect such amount of money, I have to issue this amount of shares in the old company. So practically I have to dilute the shareholders structure. So I will have 15% of share in the company. This will not affect the weighted average cost of capital at all, because already the whole funding was equity heavy, so doesn't matter that we are issuing more shares. The structure will be the same. However, in the case of a BB rated bond, which is good enough, we can see that this is the interest rate right now on the market. And also the suggestion from you was that we have to have a fixed fixed interest rate, which is nice. I can enjoy that one. So in this case, the capital will be only paid at the end of the 5th year. And in this case, the price of the bond will be this, but the notional value will only this one, because when we were calculating or estimating the price of the bond at the point of issuance, we realized that practically it will be this price. So we can sell at this notional value for this price. Well, yeah, this is the price, and that's why it's way better. So the debt is not increasing that much, not by 900 million euro, just by 8.5 million euros. So yeah, so weighted average cost of capital increased, obviously, because now we are mixing in the interest rate, not just the equity. And we can see that the weighted average cost of capital is higher, but we can see that, okay, the value of the company increased, but the distress is quite high. So we achieve nothing here. So we can say that while in the past, in case of equity financing, this went down nicely. So this is what we can remember. And now this is quite terrible. So this is where we stopped, and now we should just continue. So cost of capital increased due to diversified capital structure. Meanwhile, corporate value nor the probability of default did not compensate the higher debt levels. So we should not follow this strategy. Sad moment. Okay, then next one is, why did I keep here corporate value? It's just, yeah. Third thing, financial lease. Last week I nearly finished the financial lease. So if I'm opening the Temis sample financial lease Excel sheet, and this is what I can see here. And there was this funding sheet, And here we can see that I had insufficient amount of assets. So there is the financial lease here, there is the bank loan here. So at the end of the day, I have to increase my debt with this amount of money. So this is, I think, the worst of the worst scenario, because let's check that. Okay, I increase the debt. Financial lease is tricky. We don't care about that one. But did I increase the cash? Yes, I increased it. Okay, did we get the financial revenues? So interest payment on our, okay, on our cash reserve, yes. Paid interest is there, but also we have the lease fee, which is also reducing our profit. So at the end of the day, we are not profitable at all. So until we had at least positive zero for the first year's profit, now after hard work I was able to achieve massive minuses to stabilize our cash flows. So cash flow was stabilized, just the profit was not stabilized anymore. So achievement unlocked. But we can see that, okay, financial lease, let's talk about it, because so we have only which can participate. In the leaseback contract. So we have to take an additional with variable interest. The lease fee. Okay, so the lease fee, sorry, annual lease fee will be, yeah, this 81 million euro, which comes from 6.46% of interest rate. So the leasing firm (3.22%), then the and the commission was 2%. So again, the lease, the benefit of the lease is not because it's cheap. The benefit of the lease, it's flexibility, it's availability, then we can build up capacities fast, we can remove capacities relatively fast, and it's also that we can negotiate it quite fast, so compared to a bank loan. And also we can remove some maintenance if it's needed, but it's not cheap. So because sometimes people are saying that, oh, lease is the benefit of lease is cheap, and or why it's so expensive, because this is a service. So, and we can see that also part of commission is there. And then we know that after that, or due to this arrangements, we have to think about the debt. Profit and loss statements, see 75. says what? 35, 75. Interest on debt. How did we get this one? Yeah, this is coming from bonds. Which is great, just not the best. Because still we have to factor in the interest on the lease, if you would like to consider them. Okay, so this is that. Yeah, okay. And already we are using this one, so this one is flowed from many reasons, so you should not come from. So we have to weight the debt here, because we have to say that, okay, profit and loss statement, so there is the financial lease divided by the entire debt. Then we have to multiply it with the financial lease interest rate. And then we have to add the bank loan. Again, bracket opens, then bank loan divided by the overall debt or funding need, whatever. And then we have to multiply it with the bank loans interest rate. And then we have a big number here. So after that we just have to say that, okay, let's fix you here. And tam. Now our weighted average cost of capital is bigger than before. How bigger is this? By a lot. At least I did not double it, just nearly. So in the previous really expensive solution, I was just adding several digits. Now, yeah, it increased a lot. .7. Let's say this is 4 by 1.3%. This is an approximation. Yeah, there is. And then if you are checking value, sorry, if you are just checking distress, at least because the debt was not that much affected. That's why Ozono was not reacting as harshly as before on the level of debt increase. Why value? Okay, this is the this is salvage value, sorry, corporate value. It's still ugly. So this is the lowest ever. Yes. So this scenario, the lowest possible value growth. So this will be also rejected, at least in my case. So, as a conclusion, the new strategy will improve the value of the company. So now we can see that the new strategy improved the value of the company. However, yeah, we are not exponentially growing. Come on, we are at least growing, so we identify the risk in the first 2 years. 2 years, therefore it's necessary to create an additional capital buffer. To raise at least, oh come on, don't be shy, so 900 million euros as financial runway. So, after a careful assessment, we realize that under current funding conditions, only the can provide low VACC, can provide a combination of low weighted average cost of capital, probability of default, and high value growth. Okay, so further questions to answer, then we don't have to care about the funding anymore, because we solved this one. So sensitivity analysis towards exchange rates. So that was the solution for this specific case. So obviously in your cases, numbers can be different as your strategy is much better and more developed than what I did here. So yeah, this amount from loan, this amount from lease, and that's why it's completely disastrous. Okay, do we have any question about this one? If not, then I am uploading it. Also, I'm saving this.